Okay, we still have some battery. Okay, and now our next learning objective is classifying assets and liabilities based on their liquidity. What does it mean by liquidity? Liquidity means ability to convert into cash. So cash and cash equivalents are the most liquid assets. You can convert yuan into dollars easily, right? Dollars into yuan easily. You can present a bank, check. You can receive the cash. So that's why the draft, demand draft, this bank checks, they are classified under cash. So this is the most liquid assets. Account receivables, they are relatively liquid because cash collections usually follow quickly, less than a month, less than 2 months or 3 months. So account receivable are liquid, but not liquid as cash. Cash has first priority. After that, account receivable. So who's the most liquid among account receivable and cash? Answer is cash. And then inventory. Inventory is less liquid. Why? Because it takes more than, within the year, you make the goods, you store it to your warehouse, and then from there it will go to the middleman to the retails to the customer then, right? It takes longer time to convert into cash. So that's why it has third rank on liquidity. So if the question arises, who is most liquid? Account receivable and inventory, which one is most liquid? Account receivable. And then equipment. Buildings are even less liquid because the assets are not for sale for regular purposes. If you want to sell your equipment, it takes more time, right? Buildings, it takes more time. If you want to convert those buildings into cash, maybe it takes more than 6 months or more than a year. But also that is not the purpose of your business, to selling your own assets, right? So assets and liabilities are presented in order of liquidity. So most liquid asset will be written first when we are making balance sheet. So under each head, if we are writing down the assets, so that's why we start from cash and then account receivable and then inventory and then, the other assets. So the reason is liquidity. So classifying assets and liabilities based on their liquidity. So assets are written in two categories, current assets and long-term assets. So if we compare the liquidity among current assets and long-term assets, which one is more liquid? Current assets. Why? What are the definition of current assets? Their life equal or less than 1 year, and long-term assets life are greater than 1 year. So you can just say that, okay, after ending of their life, they are converted into cash. So current assets liquidity is higher than long-term. Similarly, with this current liabilities and long-term liabilities, which one is more liquid? Current liabilities. We talk about the current assets. We talk about that, converted to cash, sold or consumed during next 12 months, or within the business normal operating cycles, right? What are the long-term assets? Like building, fixtures, equipment, plant, right? Long-term purposes. It also includes intangible assets like patents, copyrights, trademarks, this kind of stuff. Current liabilities, similarly, within 1 year, less than 1 year, it includes accounts payable, notes payable, which are due in 1 year, salary payables, unearned revenue, interest payable, income tax payable, right? We already talked about that, but just we are learning this with the viewpoint of liquidity. Long-term liabilities, all liabilities that are not current are classified as long-term liabilities, and their life is for more than 1 year. For example, notes payable for longer term, for 3 to 5 years. You ask loan from the bank, you have to pay them in 5 years or 10 years or 20 years. These are long-term liabilities. And then format for financial statements. Sorry guys, I'm not giving you a break. So I think after we will cover this lecture as soon as possible. We still have power outage. Okay, so the format for the financial statement, there are two formats how we make the balance sheet. Number one is called report format, and number two is called account format. Similarly, we have two formats of income statement. Number one is single step, number two is multi-step. And what is the format for balance sheet? Number one, this is a report format, in which you have just one column, and that's it. In which you write it down like this: assets is equal to liabilities plus owner's equity. It means total assets. You write it down total assets, and you just make a double line here, right? This must be equal to total liabilities and total equity. See, and we have a double line here. Understand? Let us clear here. And you see, you start from current assets. The most liquid asset is cash and cash equivalents. So this kind of format is the most adopted format among companies. More than 60% of the world are using this kind of format, report format. So current assets, what are the current assets? You start from highly liquid asset. Number one, cash and cash equivalents. What are the cash equivalents? Like coins, foreign currency, bank checks, right? Demand drafts, and then short-term investments. What does it mean? Like you purchase stocks, company stocks, you have excess cash, you invested in stock exchange. So whenever you want cash, you sell those stocks in open market and you receive the cash. And then account receivable, inventories, prepaid expenses, and then we have total current asset, right? Whenever you want to have a total, you make just one line. That's it. So this is 2 years balance sheet, right? So that you can have comparison. Last year we have this much current assets, sorry, cash equivalents, and now we have this one. So you can also make a yearly basis as well. So this is called report format. So the report format basically is a very common format among countries. You will find if you just go to the stock exchange and download any company's financial statements, especially the balance sheet, it will be most probably it will be like in report format. Here we go. And then long-term liabilities, long-term assets include this kind of stuff, and then you add all the assets, and this means current assets plus long-term assets. And then we start from liabilities and shareholder equity. We start from liabilities. So this is current liabilities. See, total current liabilities we have, and then we make up one single line here. And then long-term liability, and then we have total liability. We just make a one line here. And after that, we start from shareholder equity. So we make up. That's it. So at the end, you just add them. Total liability and total shareholder equity. This 8219 came from total equity, this amount, plus total liabilities. Where is that? Here we go, this amount. So when you add this, 5114 plus 3105, answer would be 8219, which is exactly equal to our total assets. So that also follows assets is equal to liabilities plus owner equity. This equation. That's it. You have any question? No? Okay. This is called the balance sheet in account format, not report format. This is account format, in which we make the balance sheet equation like asset is equal to liabilities plus owner equity. So we make a column approach. So all the assets are written, and you see the order of liquidity here as well. First cash, and then account receivable. All the liquid assets are written according to some kind of priority here. Liquidity is the priority here. We have to write down in chronological order with respect to liquidity. Cash, account receivable, supplies, prepaid rent, and then we have land, equipment. See? So total assets are here. And then we have liabilities and then owner's equity. First of all, we write it on the current liabilities. We don't have long-term liability here, otherwise we also can write down the long-term liability here as well. And we have just make a one line and one line here. So this double line means we are adding these two lines. So 14,800 plus 68,500 answer is 83,300. So this is assets, liabilities plus owner's equity. So this format is called account format. Any question regarding the format? No? Orion, you are with us? You understand?
Yes,
Good.
I'm here.
And now let's talk about the income statement format. So there are two formats of income statement. Number one is called single step format, which means in real sense, revenue minus expenses is called the single step. That's it. So revenue, all kind of revenue, service revenue, interest revenue are written under the head of revenue, and then all expenses, salaries, utilities, rent, depreciation, supplies, income tax, right? So all these are written, and then we just less save revenue minus expenses. Answer is your net income.